Hello, my name is Elliott. I'm editor of The Energy Strategist and Personal Finance. Today I want to talk a little bit about a market that I think doesn't get enough attention, and that's nuclear power and uranium. In fact, I recently just wrote a report for the Energy Strategist newsletter covering a number of uranium stocks that I follow and some that I actually recommend in the model portfolios. The uranium market has been a very interesting place to be over the last 10 years. Now, of course, uranium and uranium oxide, really the key fuel for nuclear power plants. In about 2000, up through about 2003, uranium prices were generally trading under 10 US dollars per pound. That was a very depressed level. Uranium had been depressed throughout most of the 1990s, and spot uranium prices have been kind of hovering in that level for years and years and years. At the same time, starting in about late 2003, we began to see a notable tightening in the global uranium market. There are a couple factors at play here. One is increased interest and attention in building new nuclear power facilities. From early 1970s through the end of the 1980s, we saw somewhat of a building boom in nuclear capacity globally. A lot of this had to do with a reaction to the oil price shocks of the 1970s. You got to remember that back in the 60s and 70s, a lot of countries still used oil to produce electric power. Very, very rare today. The percentage of the amount of oil used to produce electric power in the United States has actually declined by more than 90% since 1978, which was the high. So that kind of gives you an idea of what's going on there. A lot of companies moved away from oil, of course, because it was expensive and there were concerns about imported supply. Nuclear power was a major beneficiary of this. Uranium is fairly widely distributed geographically. Countries like the US are less concerned about uranium supply because neighboring nations like Canada and other friendly countries like Australia are big potential suppliers of uranium or actual suppliers of uranium. For the Soviet Union, it worked as well because the Soviet Union is also very rich in uranium supplies. So countries really took a turn in favor of nuclear energy. We saw a building boom that lasted up until about 1990. Starting in 1990 and going up really through the present day, we've seen pretty flat global nuclear power capacity. Not a whole lot of capacity has gone away, not a whole lot of net plants have closed down. Those that have closed down have largely been replaced. However, we haven't seen a whole lot of growth in nuclear capacity. But really starting in the early to middle part of the past decade, we began to hear about plans for countries, in particular emerging markets. China, India, Russia, all these countries talked a lot more about building new nuclear power facilities. And we've really seen a lot of those plans come to fruition. Right now in China, there are 23 nuclear power plants under construction at this very moment. And there are dozens more than that in some stage of planning or approval. And there are dozens more than that that have been proposed. India is also a major potential builder of nuclear power plants. And again, Russia, another very important country to keep an eye on. So we're seeing a return to sort of 70s and 80s level of nuclear capacity growth in coming years. So a change in sentiment around the building of new nuclear power plants was one factor that helped uranium starting in 2003, 2004. The other is supply. The world uses about 170 to 180 million pounds of uranium a year to fuel the 441 operating nuclear reactors globally. Produce about 15% of total global electricity. So only about 441 reactors, pretty large percentage of total global capacity. These reactors use about 170, 180 million pounds. At the same time, in 2003, 2004, only around 100 or 110 million pounds were actually coming out of the ground. Now the reason for that is that the only mines that were still operating after the long uranium bear market of the 1990s and early part of the last decade were sort of your largest, cheapest to produce mines. No one's going to go out and invest billions of dollars in a new mine development with uranium prices at $10 a pound. You need levels a lot higher than that to make it economically feasible. So there was a real concern that there just wasn't enough mine supply out there to meet even existing demand for uranium, let alone the growth that was to come. All of this excess demand over supply was being met, by the way, through what are called secondary sources. Prime examples are government stockpiles of uranium, again, a finite resource. At one point, those stockpiles begin to wane. Another is reprocessed Russian nuclear warheads. That program has been in place for years, but it's scheduled to sunset in 2013. That particular program alone has been producing as much as 24 million pounds of uranium per annum for the world market. So that's a major source of uranium that's going away in just a few years' time. So as concerns about supply met increased optimism about demand, we saw a major run-up in uranium prices from less than $10 a pound to about $136 per pound in June of 2007. So a very quick, sharp run-up in prices. Since then, we've seen an outright collapse. The reason is, of course, that supply did emerge. As uranium prices rose, companies spent a lot more money on developing mines, and as a result, uranium production has jumped to over 130 million pounds as of 2009. Prices have pulled back all the way into the 40s. However, lately we're seeing the beginnings, the very first legs of what I believe is a second uranium upleg. Now, the reason for this is that a lot of those plants that were just being talked about or under early stages of construction a few years ago actually coming into service now. We're going to see a big expansion in the number of plants operating worldwide over the next 10 years. That's going to mean a big jump in demand for uranium, probably from the current 170 million pounds to 250 million pounds or so by 2019, 2020. So a major increase. At the same time, a lot of those secondary sources of uranium supply are coming even closer to expiration. The Russian nuclear warhead program, and again, some of those government stockpiles still waning. And while mine supply has come up, it's still not up to the full amount of annual demand for uranium, so there's still a gap there. So what we need to see is uranium prices get back up to a level which incentivizes continued production and continued investment in new mines. That level is probably somewhere north of $60 a pound, up from a current level of $46.50. So I think we're going to see a pretty big run-up in uranium prices generally over the next year or two. And I think the best way to play that are twofold. First of all, you can purchase some of the companies involved in nuclear power plant construction. One of my favorites is a company called Shaw Group. Symbol is SHAW. They own 20% of Westinghouse. They're also a major builder of Westinghouse related reactors, or Westinghouse design reactors. The even bigger play on uranium are the uranium mining companies. Now, there's some global giants out there like Cameco. Symbol in Toronto is CCO. Symbol in New York Stock Exchange is CCJ. But there's also a sort of second wave, a second act to this story. Smaller producers that are ramping up production very quickly in the next few years and will benefit by being able to sell more uranium into a rising price environment. I cover a long list of these nuclear plays in the latest issue of the Energy Strategist, which has been posted to the website. So you should check that out. But again, the basic idea is that we've seen uranium prices come up from $40 a pound up to the upper 40s lately. I believe this is the very beginnings of a next leg higher in uranium prices. Don't know if we'll get back to $136 a pound, but I certainly see $60 or $70 a pound. And if that happens, it could produce some pretty dramatic upside in a lot of our favorite uranium mining companies. Thank you very much.